All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Just doing a quick technical check here. I have something a little odd on my screen, so just waiting to get the thumbs up here. And yeah, there we go. Thumbs up. All right. We're about an hour into the market open here this morning. There are no new signals on the board, but lots to look at, lots to talk about, and some a lot of potential out there. But I'll show you kind of what's happening. I want to start with Netflix. Netflix, there's a as we've discussed here in-house about what to call the trading algorithm, and you can tell I haven't named it yet. And I like to name things, right? I like to name things, but haven't named this yet. And we've had a lot of different ideas and suggestions on what to name it. And one of the things that I've put my foot down and said, no, we're not going to use the word automated when it comes to the algorithm and to the challenge. And the biggest reason for that is it's not automated. Automated implies you push a button and it goes, right? Very little human interaction. But when it comes to the 100K challenge, while a lot of the pieces of the challenge are automated, it still can't function without a trader running it. Now, why? What happens? Well, there are decisions that sometimes have to be made. For instance, yesterday, Triple D, right? Got a signal, bear signal in the morning. Stock was down 8 cents. Looked at the options. Options terrible, not worth the risk, and go. I got a comment yesterday, hey, why don't we just go with it? Well, you got the signal, let's go. The signals are working great. And it was a very good comment, but my response was, well, that's assuming the signal works. If the signal works, yes, it will overcome the spread. But I also know the percentages of signals that work, and so I do have to factor in that, hey, it may not work. That's a reality, right? That's not I can't live in this kind of pie-in-the-sky world where, hey, everything works. No, it's about odds. And, okay, if it doesn't work, what's the cost? And just way too steep, way too steep. Can't automate something like that, right? Another piece that can't automate is Netflix, and I was kind of bummed yesterday that didn't have a trigger at the 12:30 my time, 2:30 Eastern here for Netflix, and it triggered. It triggered before the close. But, that time element I've talked about, hey, that's been one of the hardest pieces to put in and to work with. And one of the reasons is because we get stuff like this with Netflix where, it triggered in that last hour and a half of the market. And then in the first hour of the market, it makes a big move. And so when I get on video and I'm ready to go, well, wait a minute. We now have a stock that's, 3% lower, 2.5% lower than where it was the last time I was on video when it wasn't signaled. So it brings in the question of, okay, do I go and get in? And, to automate that decision, really can't do. And so while, yeah, it's there and everything at this point, right, it's now moved $7, $8 if you count yesterday. Has an average true range of just over 10. So it's moved almost a full average true range. And, I know the odds on these things, right? And, yeah, we could get more downside potential here to it. But the upside snapback risk is, very, very different here. And it's just one of those scenarios that because of the time constraints, that are in the challenge, we do get these. We do get these, and they end up being trades, that I call missed. But ultimately, it could turn around and go up, and we go, okay, good, glad we missed that. But we're going to have these, and so to use the word automated when it comes to the challenge, just can't do, right? And I know, I know it goes through my mind too. Hey, why don't we just kind of say, hey, you know what? Let's do various times. So, it can be 2:30 or it can be 3:30, and you make a valid point. But as I've talked about in the past, I believe it is very important for the long-term sustainability of Trader Minute, to have the two times, the two times where trades are made, and stick here with those, with some very rare exceptions. And something like Netflix, this isn't exactly a rare exception here. So I won't be changing that, just because don't have to make it work. But it also, does bring in, these types of scenarios, like what we see here with Netflix here this morning. So I'm not going to go after Netflix. It's not going on as a trigger, because it triggered here yesterday afternoon, after everything, and we haven't seen a lot of this in the algorithm since this challenge started. We saw a little bit in some of the testing phases, but we haven't seen it live in the challenge here so far. We've been going for about a month, and this is the first one where we've seen this type of action here. So on to the next, and on to some of the other things that are out there. There are two stocks out there where I was kind of surprised it didn't get a bear signal this morning. Boeing has a nice 3.7 downside crossover here, but the consolidation risk component is very high, and I was a little bit surprised to see that. And the other one is Micron. And, it has the downside 3.7 crossover. It's down, $3 since yesterday morning. And the consolidation parameter on it is just way too high, even though they have the downside 3.7 crossover action here with them. We have some upside crossover action in Bristol Myers. This is one that's had, downside, upside, downside. And this could be a trigger by the end of the day. The consolidation, parameter is changing here this morning with this action. Now, the algorithm is a lot tighter in the morning than it is in the afternoon. So, it is one where, it's just one where, if it were afternoon, it'd probably be a trigger. But it's not here this morning. You can see the stochastics 39.1 pushing back above 50 here on this kind of little mini breakout here for Bristol Myers. We're seeing a lot of strength in the pharmas here today. The PPH, some of these elements are leading the way. Some of the biotech elements, but it's very concentrated, right? It's not index wide. It's very concentrated in things like J&J and things like Merck, which is hitting a new high here today. So just very concentrated amongst a few. Others like Amgen not really kind of getting the same type of action here on them. Pfizer not hitting a new short-term high. So just very concentrated in a very few number of companies here. We have Teva, which has just been absolutely rinsed and crushed with this whole opioid thing. We see that the judge is asking for the settlement to be changed, and the stock's selling off even more here this morning. So Bristol Myers could be a bull signal here by the end of the day. Another one that could be is Verizon. Now, this is one where we saw Verizon pretty much tank on Monday. Had a downside 3.7 crossover, but didn't give a bearish signal. And, and I talked about it a little bit, how some of the past history on Verizon is after a day like Monday is to have a sizable bounce, come into the stock. The way it has bounced here, We do see a 3.7 crossover. You'll notice the 39.1 is below 50, and it doesn't have to go above 50 to trigger. In fact, we saw that with a few stocks that we've traded here so far. But that is a decent guideline to understand. Okay, if it's going to trigger or not. So I'll be very interested to see if Verizon triggers. It's not triggering just yet here this morning, but does have that potential associated here with it. And then another one that has the potential associated with it is Halliburton with a downside 3.7 crossover, but the consolidation component very high here this morning with it, and so we'll see kind of where it sits by the end of the day. It's also an interesting situation as I'm on video as the oil report is being released, right? So we have the energy report coming out, and if we look at oil, you can see oil's kind of bobbing and weaving here, so we get a little bit of an interesting read when it comes to energy names at this time on Wednesday mornings. But that's where we are here with that, and interesting snapback here on energy. We saw oil sell off after the bell yesterday, as some of the API numbers showed further builds. I don't see the numbers here just yet. Let's see if I can grab those here on oil. Supplies climbed 2.2 million barrels on crude, with an expected increase of 80,000. Yeah. I mean, we just continue to see supplies, just jumping. I mean, they're not moving up slowly. They're jumping. But at this point, all eyes are on Russia. And if Russia's going to continue with some of their production cuts, or they're going to halt those production cuts and start, turning on the spigots a little bit more here. But remember, when it comes to oil data, the number isn't necessarily, you can't look at the number and go, well, that's bullish or that's bearish. It doesn't work that way. Sometimes the biggest builds, that seem the most bearish, see the biggest upside reactions. Why? Because traders are positioned for, the builds. The numbers that are expected are not necessarily the numbers that happen, that are truly expected by traders. So we do see, off reactions quite often. And normally if we see a big build and oil initially reacts lower and then moves higher, it's a pretty good sign that maybe some bottom is in for the short run. And I think that's kind of how you have to look at oil here this morning, that maybe some short-term bottom is finally starting to come into the group, into the price of the black sludge there. All right. So market down about 4 points here this morning. While S&P down 3. We are seeing tech lag here this morning, which we typically have not seen. We're seeing utilities lead the way. So the market looks worse than what the index suggests when you kind of comb through it and look at all the stuff out there. But I want to show you some charts. Here's Procter & Gamble. New high today. Beautiful. Beautiful chart, beautiful stock, just absolutely, making a beautiful run. Kimberly-Clark. Same thing. New high. Coca-Cola. Similar. New high. Now, I'm not chasing them at these levels. Merck. We already looked at this one. Allstate. What do these companies have in common? These companies have in common that they're a safety net. They're kind of safer type of companies. Walmart. These are consumer staples driven companies. These are less economically sensitive companies, and we see a lot of these hitting new highs. We don't see a lot of the Amazons of the world hitting new highs. We don't see the Caterpillars of the world hitting new highs. We don't see the Boeings of the world or the FedExes of the world or even the transportation sector itself hitting new highs. We don't see energy. We don't see materials hitting new highs. XLB getting close. But we're talking about a market right now where, yeah, it's going up. It's going up. But it's a flight to safety, it's a flight to quality, and it's a flight to, hey, can I hold this if the economy kind of dips and dips sharply? We haven't seen a divergence like this in the new highs. We do have, a bunch of stocks making new highs, right? I mean, we're not devoid of new highs. If we look at the number of new highs relative to new lows that have come in here this month, I mean, that's a very healthy number up here over 300. It's a very healthy number. We don't see, we see a lot of those backing off. Some of them, the Microsofts of the world, the Visas of the world, right? There are other companies in some of the more risk type sectors like Microsoft that just recently hit a new high, and deservedly so. But, as the market has kind of hit this kind of short-term overbought position, we are seeing the flight to safety more than ever. And, you can make what you want out of that. We don't often, we don't often see it. The last time we saw this much of a flight to safety was kind of the push in 2007 to brand new highs. It's one of the most vivid memories I have of, just safety stocks leading the way. And we talked yesterday about small caps lagging, transports lagging, here in a big way. And, the market really being driven by these safety sectors. It's not something that tells you where the market's going today or tomorrow or, anything of that type of crystal ball short-term nature. But it is one of the risk factors that is ultimately growing here in the market. And it's a risk factor for both bulls and bears. For bulls, you say, well, okay, the risk factor is pretty obvious, right? The risk factor is that, hey, you know what? The money's conservative. And, generally when we see money conservative, we see a pullback. But it's also a big risk for the bears because it tells you that this has not been a very aggressive uptick yet. And if something happens that turns it to a more aggressive uptick, yeah, we'll see money come out of those safety sectors and fly into the Amazons and into the, Facebooks of the world and into the Caterpillars and into the Deere type of companies. And so it poses a risk for both sides. And it's definitely a warning sign out there. Now, we don't have other warning signs in other areas that are flashing this big, right? But I did want to note that here this morning of this kind of flight to safety that we pretty much see out there in the market right now with companies hitting new highs. It's the consumer staples. It's the McDonald's of the world who's probably buying more of their own shares than anybody else. It's some of these companies that even if there's an economic downturn, yeah, they'll be affected, right? Every company is, but they won't be affected to the same type of degree out there in the market. So we are seeing that in the price action today, but it's not new. It is something we've seen now for some time, and it's something that I suspect will continue as the trade war fears continue and mount out there. And granted, there are always exceptions, right? Under Armour was a big exception. This isn't exactly a safety net company, right? But it continues to climb into new short-term highs, and so obviously there are plenty of exceptions out there, but it is a market where we're not seeing the banks really hit new highs. The Citigroups and the Bank of Americas of the world. We're not talking about these hitting new highs. It's a much less aggressive market here on this June move than what we saw in March and April. And I think that's noteworthy. I think it's just something to kind of keep in the back of your mind. And, from an exposure standpoint of things, just kind of being aware of, of that factor. And the fact that, we are in the short run a little overbought. We see a little, flight to safety. And obviously, some things could change that. But that's kind of where the market sits right here, right now. With things, I talked yesterday about kind of the lack of signals for the challenge. Generally, what does that what does that denote? That denotes more consolidation, more of a consolidation environment shaping up for the market than anything. And while yes, we saw Triple D yesterday and we saw Netflix, but didn't really trigger at our times. We haven't seen other triggers really come in. It's been pretty light here on downside triggers, so it's still one that suggests to me that consolidation risk is still pretty high, and we're going to need a pretty sizable catalyst to go one way or the other in a very aggressive type of manner. Right? We've talked about this with gold. Right? It moves its average two ranges. Chances are consolidation. Yeah, it has a 2-day pop and a 2-day drop, and and now right back in the middle of the consolidation. I would not be surprised to see a lot more stocks kind of going into this type of mode here in the in the short run here. Okay, and it's common for the summertime, common to see that, and something where something where you don't fall asleep on it, right? You absolutely can't, because it can change fairly quickly, but it's not something that's going to change minute by minute. It is something that will change with some of the bigger factors that are out there. Thanks for hopping on. Have yourselves a fantastic day, and we'll talk to you this afternoon. Take care.